Welcome, everyone, to Build and Leverage Credit to Grow Your Business and Get Financing. I'm Gerri Detweiler, Education Consultant for Nav. Nav believes every small business owner deserves the chance to succeed. And we're here with Startup Nation. We'll share some resources at the end, but in the meantime, we want to dive into our conversation about credit. So, here we're going to focus primarily on business credit, why it matters, how it works, how to build business credit, and we're going to tie it into some of the most popular financing challenges and options that business owners have. And then finally, we will share some tools and resources. So let's just start out with why you should care about business credit, because my experience has been a lot of business owners simply don't know it exists. If they do, they don't know why it matters. They've never really seen the direct impact in their business for a variety of reasons. And so they think it's not important. And that is not true at all. The Federal Reserve surveys small business owners every year. And a few years ago, they asked business owners, hey, those of you who got financing in the past year, how did you qualify? Was it based on personal credit, business credit, or both? And you can see from this slide that 12% of business owners said, I only used business credit to get financing. 40% said, I only used personal credit, and 48% said, I used both. So at NAV, we emphasize that both business and personal credit is important. But since business credit is a bit more of a mystery for many people, that's what we're going to focus on explaining in this presentation. So here's how small business credit can impact your business. The first is insurance. So when you go to get insurance for your business, and almost every business needs some form of insurance, they may check your business credit. We had a NAV customer who had an insurance agency, and he was having trouble getting insurance for his insurance agency. And it turned out that his business credit was mixed up with that of another business with a similar name in a different state. And that information was not good. So once he got that corrected, he was able to get the insurance that his business needed. So you do want to think about this in a broader context than just financing. Another one is contracts. So whether you're looking for government contracts or you want to do business with large commercial clients, which can sometimes be very lucrative, you probably will need some form of a business credit profile, and there will probably be some form of a business credit check. So for example, I was on a webinar with accountants, and one of them reached out to me afterward, and she said, I worked in the supplier department at one of the country's largest retailers. You'd recognize their name. And she said, we always checked a DMB Paydex for our suppliers. And she said, most of the business owners I talked with had no idea. They didn't even know what Dun& Bradstreet was. So if you want to move up to more opportunities for your business, this is important. And your business doesn't have to be huge for this to come into play. NAB's co-founder, Levi King, he experienced this in his sign manufacturing business where he put in a bid. He was certain he was going to get it. He knew it was competitive. He knew he'd work hard. He knew the price was good. And it turned out that there was some information he didn't know about on his business credit that led to his competitor getting that job, which was a significant loss for his small business. So just keep this in mind if you're thinking about growing your business. Another one is financing. So whether it's getting supplier credit, which we'll talk about, SBA, certain SBA loans, bank loans, equipment financing, there's a variety of types of financing options that may look at business credit, either to approve your application or to review the status of your loan once you already have a loan or financing with them. So lenders and other companies can get business credit reports from business credit bureaus. So just like on the personal side, you have Equifax, Experian, and TransUnion. On the business side, the three most widely used bureaus are Experian, Dun& Bradstreet, and Equifax. Now, you see that Experian and Equifax fall in both the personal and the business categories, but I do want to emphasize that those databases are separate. So Sometimes I'll hear people say, well, I'm checking my business credit, and now they're mixing my personal and business credit together. And that's not true. There are some credit scores that can look at both sets of data, as we'll describe in a moment, but those are completely separate databases, business and personal credit, even if the bureau's name looks the same. And I also want to mention the Small Business Financial Exchange. This is not a credit bureau, it's a data warehouse, but it falls into this credit ecosystem. And here's how it works. Large lenders like your major banks, major equipment financing companies, etc., become a member. And then when they become a member, they contribute information about how their small business customers pay their bills. And then if someone wants to get access to that payment data, they go to one of the bureaus and they purchase a credit report that includes SBFE data. So no one goes directly to the SBFE to buy a credit report, but they can get that data through partners like the bureaus that we've just talked about, as well as a few others. So it may affect your credit, but you won't necessarily know directly that it's affecting your credit. Uh, and I want to bring this up because, for example, a few of the major small business credit card issuers don't report directly to these bureaus, but they report to the SBFE. And so that information could become part of your business credit report if someone purchases one that includes SBFE data. Now, if you've never checked your business credit before, it's going to be a different experience. So I want to prep you for this right now. It's not going to be quite the same as when you pull your personal credit. There's not the same level of uniformity with business credit reports as there is with consumer credit. So consumer credit is very regulated. And all of the credit bureaus have pretty much gotten on board with a system that helps the data exchange so that it's not completely different from one credit bureau to another. With the business credit, each bureau has its own policies, procedures, companies that report, the credit scores that it creates, et cetera. So here are the three main differences I want to point out from the beginning. So the first is if you get your business credit report, it probably will not list the name of the companies that are reporting your payment history. So for example, when you get your personal credit, you have a mortgage, you see it says your mortgage is with, I don't know, your local bank or Bank of America or a credit union or Wells Fargo. It will just list the type of account. So a utility account, a communications, food distribution, a credit card, this is material handling. There's different ones, different categories that may fall into. The reason I bring this up is because if you're in the early stages, especially of building business credit, it's really helpful to keep track of your business credit as you add new accounts, because sometimes it's a little tricky to figure out, okay, which account is reporting to which bureau. If you're monitoring your business credit through this process, then you can see when an account gets added that you just opened, and you can kind of figure out which one is which. Otherwise, you may have to be a little bit of a detective. The second factor is that's very different is how payment history is included in business credit reports. So it's much more granular. It actually operates on a daily basis. Your personal credit payment history falls into 30-day buckets. So, let's say money's tight this month, you pay your personal mortgage 5 days after the due date, but they don't charge you a late fee because you're still within that sort of window before a late fee kicks in. And they probably don't report it as late to the credit bureaus because usually on personal credit, they usually don't report until it's 30 days late. With business credit, they use something called days beyond terms. So this is the number of days beyond the due date that you pay your invoice or your account. So you could be 2 days beyond terms. You could be 5 days beyond terms. It's much more granular. Now, doesn't mean that you need to freak out if you're accidentally a day or two late. That's not uncommon, but when you're in the credit building stage in particular, I'd really encourage you to set up systems so that you pay on time because that will help you build a strong business credit history and will um, help lenders and other companies that are seeing your credit to see that you pay on time. And we'll talk about payment history a little bit more in a moment. And then finally, your credit scores can differ significantly. So on the consumer credit side, you have pretty much FICO scores and then Vantage scores. And then the bureaus have some of their own proprietary or their own credit scores they've created, but most of the credit scores that are used on the consumer side come out of those two companies' formulas. With business credit, it's very different. So you have each credit bureau typically creating its own credit scoring model. And then you also have the fact that some lenders report to one bureau and not to another. If you have a consumer car loan, chances are it shows up with all three bureaus, Equifax, Experian, and TransUnion. If you have let's say a commercial vehicle lease, it may not show up with all three major business credit bureaus. It may get reported to one. It may just get reported to the SBFE and get pulled in when someone purchases a report with that data. So, what that means for you is that you may see very different credit scores bureau by bureau. So, I would encourage you to look at all three and not just monitor one. I would encourage you to make sure that you understand what each of them said because you don't know what a lender is going to look at. You don't know what credit bureau a lender will choose to use. So, knowing where you stand with each one can be very helpful. So, what's a good business credit score? I'll let you think about this and maybe either in your head or on a piece of paper, jot down a number. So when I typically present this information, usually the responses I get are similar to personal credit. So people will say 720 or 780 or 800. With business credit, as I mentioned earlier, each bureau has its own credit scoring models and they have different score ranges. So here are a few popular ones. These are the ones that you'll see, for example, if you are using Nav Prime to monitor your business credit, but there are plenty of others. So we'll share a resource with a chart that shows the variety of different credit scores and credit score ranges coming from each of the major credit bureaus, but they can be very, very different. So the practical application for you is when you check your credit, no matter where you're getting it from, always look at the score range. So don't just look at the number, look at the range and see where you fall. If you're using Nav, you're going to get an idea of whether that's great, could use some work, or maybe needs a lot of work. But regardless of the source, always look at where you fall in that scoring range. All right, there's also a FICO score for small business. Now, it's not the same as consumer credit, where FICO scores are very, very, very widely used. It's a little bit different, but there is a FICO score for small business called FICO SBSS. And this score is interesting in that it can combine personal credit data, business credit data, and even financial information. Now, it is used for certain SBA loans as the first level of credit screening for these SBA loans. And so your business will need to get a passing score to move on to the next step. If you don't, then it will be taken to manual review for more a closer look at your credit. At Nav, what we've found, and Nav is right now the only source for seeing this information directly as a small business owner, or at least one of the only few that offer this directly to small business owners. So what we see at Nav often is that you can have really strong personal credit and get what would be considered a passing score for the SBA loan program that you're looking into. But it's easier to get a good FICO SPSS score if you have good personal and good business credit. So that's one reason why we encourage business owners to check and monitor and then build a business credit history if they want to go for financing. And some of the best financing you can get comes from banks and other financial institutions that may use, this particular credit scoring model. The other thing I'm going to mention real quick there, and you might have caught it, but if you didn't, they can look at up to 5 owners' personal credit. In other words, it can pull in data from up to 5 owners. So with the SBA loan program, let's say you own a business 50-50 with someone else, each of your credit will have to be checked for the SBA loan. That's a requirement. And that's not unusual with other types of financing as well. I was at a workshop where there was a panelist of bankers in the front of the room, and someone stood up and said, "Hey, I have great credit, but my business partner does not. Is there any way for us to get a loan without checking their credit?" And every single banker said no. We are going to check the credit because we want to know all the owner's personal credit situation as well as their business, as the business credit of the business. So eventually, as you grow your business and build business credit, you can get away from those personal credit checks. But certain types of financing, like SBA loans, are always going to check personal credit. And so it's something you want to be aware of. All right, so now we need to get into the heart of things and talk about how to build business credit. So if you're not familiar with this process, we're going to lay it out. It's not difficult, but it does take a little bit of work, and it takes a little bit of time. So we really encourage you to think about this sooner rather than later. The sooner you get started, the more that credit history will help you over time. If you wait, it can be hard to catch up, especially if you need financing pretty quickly and you want to use business credit to help secure that financing. So the first step, we encourage you to think about creating a business entity and talk to your financial professionals, your accountant, attorney to figure out what's best for your business. But something like an LLC or corporation offers a lot of benefits for your business, but it also offers benefits for building business credit. You can build business credit as a sole proprietorship. That means you have no formal business entity. You're just doing business under your name. The challenge is that as a sole proprietorship, there's no legal separation between you and your business. So you and the business are the same entity. So it's really hard to truly get away from personal credit because it's you. So there's not really a distinction between you and your business. The other challenge is that let's say you do start as a sole proprietorship, you operate that way for a couple of years, and then you decide to form a business entity. It may be difficult for that business credit history to carry over to your business entity because you're going to have a new EIN, you're going to have a new business name, etc. So just keep that in mind. However, if you are going to operate as a sole proprietorship, and I understand there's sometimes some states like California have a very high fee for operating as a business entity, and maybe that's just not realistic for you right now. I would encourage you to do a couple of things, think about a couple of things. One is to choose your business name carefully. So definitely do some research so you're not choosing a business name that's like every other business, and you'd be surprised. I wrote an article where I looked at the Florida Department of Corporations and I just did a search for, I think it was China Gardens, because that's a kind of a common Chinese restaurant name. And there was more than a dozen. And looking at more information, they were not related businesses, but they were businesses with a very similar name. And so I think we're in the same state. So you could see how easy it'd be for that information to get mixed up with another business with a similar name. So I would sure encourage you to do your research and choose your business name carefully. And then I would also encourage you to think about registering that business name. So with your state. So for example, filing a doing business as DBA or a fictitious name, it's called, so doing business as whatever the name of the business is. And one of the reasons for this is it puts everyone on notice and it may actually help start the credit file process because some credit bureaus will pick up on state filings and use that information to help, start building their credit database. And then I would also encourage you to get an employer identification number or EIN. It's free from the IRS. And this is the sort of like the Social Security number equivalent for your business, just to keep it's another way to help match your business credit history to your business. It's not it's not as ubiquitous in business credit as personal credit. In other words, we've looked at NAV at the database and not, there's a good number of businesses that don't have an EIN listed, but it is something that can help. So when you fill out a credit application, you provide the EIN. It can help make sure that your credit history gets matched to the right business. If you form an entity, you will have to get an EIN. That's automatic, and then you'll use that when you go to apply for credit. So these are a few steps that we would encourage you to think about. If you're not sure about forming a business, I will be sure to share a link with a recording to NAV's Business Formation Resource Center where you can look at the options for forming that entity so you can get started. All right, the second step is to make sure your business is what we call legit, or make sure your business looks like a real business. And I don't want to underemphasize this because a lot of people just start their business, and these days it's easier than ever to start a business. I think this past month, something like 450,000 new business registrations were filed in the US. So it's very easy. But you need someone who's looking at that credit report to see that your business is legit because there is a lot of business failures and a lot of fraud. And so the fact that your business has taken these extra steps helps ensure that your business will appear less risky. And as you build your business over time, it will be less risky. So you can operate your business from a home address if it makes sense for your business. So you can use your home address. If you don't want to give out your home address publicly, then you could also get a mailing address to go with it. So there are services that will give you a mailing address, maybe a suite number for your business. Um, the USPS also offers PO boxes. I've heard mixed things from creditors about whether to use that or not. Um, Ones that I've talked to have said, as long as it makes sense for the business, we're okay with it. What I've done for my business, and I have been had my corporation for a couple decades now, is using a home address for the legal reasons, because the IRS, for example, wants a home address. They want a physical address. And then using a mailing address for the anything that I file publicly. So a website, a filing with my State Department of Corporations, anything where I'm going to get mail or give out my address to the general public, I use that mailing address with a service that collects the mail, scans it, and then shreds it when I don't decide I don't want it. You can also get a business phone number. So I would really encourage you to think about this. Having a separate business phone number just makes it a lot easier to operate your business because then you can set up business hours for that phone number. You can set up more professional answering for it. And if a creditor is going to call you and you're going to answer in a very casual or informal way, it just may make it sound a little less like a real business. So there are services that can make this easy and inexpensive to do. Then finally, I would encourage you to have an email and digital presence that is in the name of your business. So get a URL for your business, an address on the internet that is for your business. I would definitely avoid the very generic email addresses for a business email. It doesn't look quite as professional. And, what if let's say you're with a certain provider, you change that provider, but you can often link up your personal email to one of these business email addresses or get a separate business email address and have a very professional URL and domain name. I know some businesses these days are operating with just say, let's say a social media page, maybe a TikTok account, Instagram page, whatever, and that's fine to use that, but have your own address because if you get well, we saw what happened with TikTok not too long ago where, they banned it and then the new accounts couldn't get on it. And then we also have seen people get kicked off of a platform. And if that happens, then there goes your business. So have a home for your business on the internet so people can find you. And then know your industry. So let's talk about these industry codes for a second because they will have an effect on different opportunities for your business. I have felt this firsthand in my business. It was pretty much misclassified at the beginning, and it still has had repercussions as little as a couple of years ago for my business. And so I want you to understand how this works. So the government decades ago created these codes that they were using for statistical tracking purposes. The Standard Industrial Classification Code or SIC code was the first one. And that's a code to say you're in manufacturing and trucking, in um, you have a landscaping business, whatever it may be, right? Uh, and then they later came up with these North American Industrial Classification System codes, or NAICS codes, as they're sometimes called. And those are a little more granular, and they were designed to bring in all of North America, Canada, and Mexico as well. And again, they were created by the government for statistical tracking purposes. The government does not assign you these codes. They have a manual that lists all the codes, and it's up to you to figure out what code best represents your business's main source of income. So you have to go to the directory and figure out which code is best. Now, here's a tip. At least as far as I know, it's still operating. The Census, U.S. Census Department, has a tool called Dr. Nakes. And so if you can't figure out the right code, and sometimes the perfect code doesn't exist. That's especially true with the newer digital economy where there's not a lot of codes that are great for example, digital creators or content creators. Um, but you can actually email them and they will help you identify the correct code for your business. So this is another resource that we've written a lot about at Nav on the Nav blog, and I will share a link to a resource that can help you figure this out so you can get the right code and use it going forward. Now, if you check your credit and the wrong code is on there, you can certainly dispute it and ask that it be updated. And where it may come into play is with financing offers. So we had a NAV customer who manufactured the signs that real estate agents would put in the front yard to sell a house, and he was not getting financing offers. And it turned out his code, his NAICS code or SIC code, I can't remember which one, on his credit report listed that he was in real estate, and he wasn't. He was assigned manufacturing business. So he did get that corrected, and then different types of offers came in. So something for you to keep in mind. All right. Now, once you've had this foundation laid, and these steps, by the way, will be in a guide that we will share with you after this webinar. So don't worry if you're frantically taking notes, you will get a step-by-step guide with more information and more resources. So the next step is to build credit with trade lines. So your credit score is heavily dependent on your payment history. They use information about how you've paid your bills in the past to predict how your business is likely to handle credit in the future. That's how a credit scoring model works. It looks at risk factors from a very mathematical standpoint. And then in business credit, we still have a lot of vendors and suppliers and companies that will still look at credit reports, and they'll look at what's on the credit report to see whether it looks like a good risk for them. So the heart of the credit report and the credit history is how you paid your bills. And to do that, you need accounts that report. And I cannot tell you how many times we've seen small business owners who have been in business for a dozen years and don't have business credit. They just don't have a credit history. They haven't used accounts that report to business credit. And so their credit history is very thin or non-existent. And that can lead to a low credit score. So it's not uncommon for a business owner to have a low credit score, not because they have any late payments or any negative information. It's just they don't have enough information reporting. So you need accounts that report. And one of the easiest ways to get started and without taking on debt is to start with what are often called trade lines. And this often refers to accounts like supplier or vendor credit. This is where your supplier will let you buy something now and pay for it later, hopefully out of cash flow. So let me give you an example. Go back to NAV's co-founder, Levi King, when he started a sign manufacturing business. He had no credit, no debt, but also cash flow was very, very difficult. And one of his suppliers said, "Hey, you don't have to pay for all this up front. You can fill out a credit application." So then he could get the steel or cement or plastic that he needed for these large sign installations and build a sign, deliver it to the customer, and then hopefully pay that back out of the payment from the customer. So it completely opened up new growth opportunities for his business because he wasn't always quite as strapped for cash. And that was the beginning of his business credit journey that eventually led him to founding NAV. But the same thing can work for you. And if you choose suppliers that report to business credit bureaus, then you can also get that account reported. So you get the benefit of cash flow and credit. If you pay on time, you're building a credit reference that can appear on your credit report. Nav does have a list. It's one of our most popular articles on the blog, a list of easy net 30 vendors. Not all of them, some of them you will need a few payment experiences, but they're all easier to get than many of your more traditional types of financing for a business and often are available to younger businesses as well. I will note that a number of them do require a business entity. So you may need to be an LLC, operate as an LLC or a corporation in order to get one of these Net 30 accounts. But we'll share the list with you and the resources so that you can check that out for yourself. The second thing is Nav Prime. So we'll talk about Nav Prime a little bit later, but Nav Prime reports, submits monthly as a trade line to the major business credit bureaus. So you're building a credit history with that payment and all the other benefits that you get. And again, we'll talk about that in the resources section. So that's another option. You could also talk to your current suppliers if you have them and ask them if they report. And if they do, that may be helpful. Dun& Bradstreet offers a paid option where you can get accounts added to your business credit report where they will manually verify them. Not all types of accounts are eligible, but some are, so that may be an option. But that's strictly with Dun& Bradstreet. Those won't appear on your other business credit report. So ideally, I would recommend you try to get at least 2 to 3 to start with each of the major bureaus. Eventually, you'll probably want more, but that's a good place to start. And if you're monitoring your business credit, like with Nav Prime, then you can see when those accounts report and you can start seeing, okay, hey, this account is reporting to this credit bureau. This is how it's classified. And that will help you in that early process of getting this, getting this going. So it's one of the best ways to get started. The other thing I will just add real quick is that with most of these options that I've just talked about, you do not need to have good personal credit. Personal credit check is either non-existent or very rare. And so you can start this process even if you're working on your personal credit as well. Another option for helping to build your business credit history is a business credit card. So this can be very useful because credit cards report as a financial account. So it's a little bit different than the trade credit. It's also a type of credit reference. But it shows, it usually shows that you have a larger credit limit that they've given you access to. And that allows you to demonstrate the ability to, pay for something over time. Most small business credit cards do report to at least one of the major business credit reporting agencies or to SBFE and sometimes both. And we do have information about that. It's in the guide that you'll receive as well as on the Nav blog, or you can scan the QR code that you see there to get more information. And we'll talk about credit cards in just a moment because it's a really important type of financing, especially for younger and newer businesses. Now, once you have these accounts, it's essential that you pay on time. Very essential that you pay on time because of that what I talked about earlier, where it's so granular, the fact that, if you're just a few days late, that may show up on your business credit report and may affect your credit history. So I would encourage you to think about setting up automatic payments if you can, or at least setting up alerts. So you get busy in your business. Things go very, very quickly when you're working really hard. And so you don't want to miss that payment. Now, there is a difference between having a paying on time and keeping an account active. So I had a discussion recently with a credit manager at Coast to Coast Office Supplies. They're one of the companies on NAV's Net 30 list. And he said, one thing we see is that our customers will get a Net 30 account and then they will pay it off like in 3 days. And he said that doesn't translate to any information on the credit report other than that the account is current. So yes, it shows you're paying on time, but it doesn't show that you're using the account or keeping it active. So what he tells customers is, look at what date the company reports to the credit bureau and then pay after that date, of course, still within your due date. So if your due date, let's say the due date for the payment is January 5th, and the company reports on the first of the month, then wait until the second or third of the month to pay that account. So you show some activity, but you also show that you're paying on time. So it sounds a little more complicated than it actually is. Once you get the hang of how this works, it's very easy for both credit cards and for accounts like Net 30 accounts to get within that window of the sweet spot of where you're using credit, but you're paying it on time. And you can even avoid debt and interest charges by taking that approach. All right, the last thing is fixing errors on your credit report. This is important. There hasn't been a recent research study on this, but the one that was done a number of years ago with the Wall Street Journal and another analytics firm found that the rate of mistakes on business credit reports was pretty significant. About 20% of business owners identified, 20 to 25% identified mistakes that could have a material impact on their credit. My thought about this is that if you don't check your credit, you can't guarantee it's correct. And that's true of personal credit or business credit because no matter how good the algorithms get, mistakes happen, whether it's from a creditor that reports a mistake, whether it's from getting mixed up with somebody else with a similar name, whether that's your business or personal name. There's lots of things that can go wrong here. And ultimately, you're the one who needs to look at that credit report and see whether it's correct or not. So I found mistakes on my credit reports. I think most people at some point do. And so if you're not checking it, you won't know. And then that information could affect your business and you don't even know what happened. The requirements for them to tell you if your credit report was a reason for not getting business financing are not the same as they are with personal credit. It's just not regulated the same way. So you may have a mistake on your business credit that results in you not getting that opportunity, like Levi King with the job that he bid on, and he found out after hounding the credit manager who made the decision at that business, he found out that it was due to this information on his business credit. He wouldn't have known otherwise. So definitely check and make sure that yours is correct. All right, I said that was the last thing, but here's one that's really important. So let's add this one. UCC liens. So this is something that only appears on business credit reports. It does not appear on personal credit reports. So there's something called the Uniform Commercial Code, and it governs regulations about how businesses operate. And a company that offers financing can can file this notice in the public record. And by the public record, I mean they go to a courthouse or through a courthouse, file this notice that tells the world that they have a security interest in the property of the business. It's called a UCC lien. So any of you who might have gotten a EIDL or economic injury disaster loan during the pandemic for $25,000 or less, you may have noticed the SBA filed UCC filings or UCC liens on those businesses that got the larger EIDL loan. So the rest of the world knows, hey, if this business defaults, we have first dibs on this property of the business. So this can happen whether you pledge physical collateral like equipment, or it can also, you might have to pledge accounts receivable or inventory or things like that. So check your credit reports carefully for this section because what we've found at NAV is that financing companies and lenders are great about placing UCC filings. They aren't always great about releasing them. So when the financing is paid back, they have to go to the courthouse and file the release, and they don't always do that. So it may look like your business still has an outstanding lien, even though the debt has been satisfied. Unfortunately, it's state by state, courthouse by courthouse, and it's very different all across the country. So I don't have a single one easy way to fix this. You have to look at the courthouse where the UCC filing was filed and then either get in touch with the creditor or get in touch with the courthouse and find out the procedure to get that lifted if it's incorrectly on there. But it's important enough that I would encourage you to look for that on your business credit. And if it looks like it's not correct, to do a little bit of investigation and try to make sure that you do correct that. And of course, if you are getting financing, ask, are you going to be placing a UCC lien? And against what type of UCC lien? So you understand that that's part of the equation and that, could have an impact on getting additional finance because other lenders might look and say, hey, they've got a lot of outstanding liens. We're not going to get behind all of this. Depends on the lender, what they want to do. All right, so that's your overview of business credit. You're going to get a guide that's going to walk you through these steps and give you more details. And we have tons of details on the Nav blog as well. Now, personal credit also matters. So I do want to make sure that you know to check your personal credit and monitor it with Equifax, Experian, and TransUnion. These are the three major consumer credit bureaus. Um, Especially when your business is younger or not making a lot of money, you will have personal credit checks. And there's certain types of financing that I mentioned, like SBA loans, where they will check your personal credit. It's just a given. It's part of the program. So it can impact your ability to get financing. So check it and work on it. But as I mentioned earlier, you these can operate separately. Like you can still work on building business credit even if your personal credit isn't good, and vice versa. So you can still work on these on parallel tracks. But when you get them both, working well, and when your credit history is strong on the business and the personal credit track, you have a lot more options. Your business will have a lot more options for financing, and you'll find it much easier. Now, there's one personal credit factor I want to emphasize because we see this a lot at NAV, and we want to make sure that you're aware of it. And that is credit utilization. So, on your personal credit report, and this also is on some business credit scoring models, they can compare your balances to your credit limits. Or in the case of business credit, if a credit limit isn't reported, they'll compare it to the highest balance on the account. So you have a credit limit of $1,000, your balance is $500 using 50% of your available credit. There's no magic number on the personal credit side. FICO says the best scores are go to consumers who have about 10 to 12% utilization. On the business credit side, often you'll hear 10 to 30% range is kind of a sweet spot for that factor. But what we don't want to happen to you is that your business credit impacts your personal credit, and then it makes it more difficult to get more business credit. So, what happens there is if you're using, for example, your personal credit cards for your business, and you need to charge a lot. Maybe it's seasonal inventory. Maybe it's a slow season for your business. Maybe you had unexpected expenses, or a client paid really slowly and you've had to put everything on the credit card till you get paid. That can, if you're using a personal credit card or your business credit card that reports to personal, most don't, but if you do, then that can impact your personal credit score. So here's an example. I was at a workshop where a business advisor told me about a client. She had had some financing fall through at the last minute. So she maxed out all her credit cards, business and personal. And a year later, she was able to refinance with an SBA loan. SBA loans do allow refinancing in certain situations. So she refinanced her debt, and she was able to bring down pay off those personal credit cards that were used for her business and bring down that utilization from like 100% to next to nothing. And her personal credit scores jumped over 100 points as a result. So she saw a huge jump by moving that debt off of her personal credit reports. Now, doesn't mean that a business credit card is not a good idea for building personal credits. It can be, but you do want to watch that utilization because you want to make sure that you're staying within that lower range so that you don't end up um, inadvertently impacting your personal credit by the activities of your business. And one way to do that is there's several ways to do it. One is to use a dedicated business credit card, either that doesn't report to personal credit or that you pay off very quickly, or to pay down those balances on those cards with high balances, pay earlier. So most credit cards report your balance at the end after the statement closing date, which is listed on your statement. So if you look at your statement, you see statement closing date, that's when they report. So that is when that is if you can get the balance down before that date that it reports, that can be helpful. So for example, let's say you have a big charge and you're going to use 90% of your credit limit. And let's say it is your closing date is the 25th of the month. You go in on the 20th, you make a payment, and when that statement closes on the 25th, the balance is lower. The credit card company sends that balance over to the credit bureau, and lo and behold, you have a lower utilization, lower balance. So that may be one way to do it. Raising your credit limits can also give you more leeway for that. And then if you refinance, like the example of our business owner who refinanced with a debt that didn't appear on her personal credit, she was able to get that utilization down, and that was helpful for her personal credit scores. Now, I want to touch on business credit cards before we go to some more resources because these are a very important type of financing, especially for younger businesses. There aren't a lot of options for brand new businesses. There are some, but there are not a lot of options. Brand new businesses, though, can often get a business credit card immediately. So you start your business today, you get a business credit card tomorrow. That's because most of these cards are going to look at your personal credit and income from all sources, not just the business. So your business doesn't have to be making money yet. If you have household income, that would be available to pay the debt. In addition, there are a number of cards that have 0% intro APRs for 7 to 18 months. So that means if you can pay that debt off before the intro rate expires and you pay on time each month, you can get away with no interest on those purchases. So that can be a good source of startup financing. Now, I want you to be careful, of course. I want you to make good decisions because you don't want to end up with debt that you can't pay off. If you don't pay it off when that intro rate expires, it'll jump a lot. You'll have a high interest rate. So you do want to make sure that it's doable for your business, but this is one of the most flexible types of startup financing. And then most business credit cards, as I mentioned, do report to business credit, so they can help you build business credit. And it's also one of the safest ways to pay for purchases. If your card is lost or stolen, used fraudulently, the most you'll be liable for is $50. If your business debit card is lost or stolen, yes, you hopefully will get your money back, but in the meantime, you may not have access to the money you need to pay bills. With a credit card, you dispute it, and then the credit card issuer gets involved in helping to resolve that. So, I would, again, I've used the word encourage a lot. I would suggest. I would suggest that you check this out as an option for your business. But again, be very careful because credit card debt is stressful. It can eat up your cash flow, and it can also end up coming back to you personally because most of these small business credit card issuers do require a personal guarantee, which means if the business doesn't pay back the debt, you are on the hook for it. So use it wisely. All right, so we're going to touch really briefly on lending here. We have another entire presentation that goes into lending options, but we want to touch briefly on it here, but can tie it back into credit because that's what we've been talking about. So most lenders are going to look at three major things. You're going to look at the revenue and cash flow of the business. So how much money is your business making? Time in business. How long has your business been around? A lot of financing requires at least 6 months to 2 years or longer in business. And especially if you're looking for bank loans or traditional loans, often they want to see that your business has been around and in business for a while. And then finally, personal or business credit. So the one we focused today on is business credit. Personal credit is also important. Time in business. So forming that business entity or getting your business on record with the state earlier rather than later can be helpful for that to start that clock ticking for when the business was started. And then revenue or cash flow, which is often documented through business bank accounts or bank statements. So if you do not have a business bank account, get one. I'm going to say that personally. I shouldn't give that recommendation from Nav because that's Nav is not your financial advisor. But I personally, as a business owner, have benefited from having a separate business bank account. And the way I like to do it is I like all my money to go into that account. So, for example, let's say I get a payment from PayPal. I have a client who wants to pay by PayPal. Then I don't use that PayPal as its account as its own checking account. I have that money deposited into my business checking. If I get a payment by Venmo, I have a Venmo business account, then I want it to go into that checking account. That way, anyone who looks at that will see how much business money my business is making. And also, I can manage my cash flow because I can see how much is coming in and out of my business in one place. If you have multiple accounts and business coming in and out, or money coming in and out from different sources, it can get pretty difficult to manage your cash flow. All right, so let's go into some resources for you. First of all, you will get a handout. So remember, you will get the Build Business Credit Checklist and some of the resources that we talked about. So this is the e-guide that you're going to receive that will walk you through these steps and will have information about some of the resources that I mentioned, additional articles that you can read if you need to delve into a particular topic a little bit more deeply. Then let's talk about Nav as well. So Nav is the all-in-one platform for your business and personal credit, and also offers tools to help you track and manage your cash flow and basically, keep on top of the financial health of your business with the goal of building a financially healthy business. So with Nav Prime, which is the paid option, you will get detailed credit reports from business for both business credit reports and personal credit reports, business credit scores, as well as updated monitoring so you can stay on top of your credit. Now there is a free option, but the free option, I just want to point out, does not build business credit. It doesn't provide a trade line because it's not reported because you're not paying anything for it. So with the Nav Prime account, that is reported or submitted as a trade line to the major credit bureaus to help you build a business credit history, in addition to then letting you check and monitor your business credit. So you can see it's sort of a full cycle system for helping you with that particular aspect of your business. And then you'll also get financing insights. And there's a marketplace where you will see offers tailored to your business. And Nav is not going to sell your information to lenders. So it's not like some of the online aggregators where you fill out a form and suddenly you're getting phone calls from a million different, financial professionals of different types, because that's not how it works. Instead, you go into your Nav account and then you can see what is being offered and available, including business credit cards and other types of financing. So check it out, and it may be a great tool for you to start this process and then to keep on top of this process as you move forward with your business. In addition, this webinar was co-sponsored by Startup Nation, and Startup Nation is like the OG of small business insights and information on the web. They've been around a long time doing great work, helping small business owners and potential entrepreneurs navigate, all the complexities of starting a business. So they have a free newsletter that you can sign up for, and I would suggest that you do. I used that word encourage a lot, didn't I? Startupnation.com/newsletter dash sign up. That is the way to get started and get updates on all the great information that they're sharing on, again, a wide variety of topics. And then we also want to thank Verizon. Verizon's Small Business Digital Ready is a great resource. It's a community for small business owners. Check it out. And if you join the community, which is really terrific, and you don't have to pay anything to sign up, you may also be able to be part of their small business grant program. So I know my audience loves small business grants. It's one of the most popular topics I've ever talked about. And this is one place to look for those opportunities, as well as get all kinds of resources and support for your small business. So thank you to Verizon for also being there to help support small business owners, not just during National Small Business Week, but all throughout the year. So I hope you found this helpful. If you have additional questions, again, NAV is here to help. NAV's goal is to help small business owners succeed, and we want every small business owner to have the chance to do that. So reach out with questions and let us know how we can help you in your journey. Thank you.